We begin tonight's SD Bullion market update with a brief but very important essay written back in the year 1999. The book's entitled Debt and Delusion, Central Bank Follies That Threaten Economic Disaster. Just before I began doing SD Bullion market updates here about 16 months ago, I had the pleasure to sit down and speak with the book's author, Dr. Peter Warburton, a financial expert out of London. Here's how he summed up the ongoing battle between real price discovery capitalism and the artificial kind we have been collectively living under ever since this book was written, back in 1999.
What we see at present is a battle between the central banks and the collapse of the financial system fought on two fronts. On one front, the central banks preside over the creation of additional liquidity for the financial system in order to hold back the tide of debt defaults that would otherwise occur. On the other, they incite investment banks and other willing parties to bet against a rise in the prices of gold, oil, base metals, soft commodities, or anything else that might be deemed an indicator of inherent value. Their objective is to deprive the independent observer of any reliable benchmark against which to measure the eroding value, not only of the US dollar, but of all fiat currencies. Equally, their actions seek to deny the investor the opportunity to hedge against the fragility of the financial system by switching into a freely traded market for non-financial assets. It is important to recognize that the central banks have found the battle on the second front much easier to fight than the first. Last November, I estimated the size of the gross stock of global debt instruments at $90 trillion for mid-2000. How much capital would it take to control the combined gold, oil, and commodity markets? Probably no more than $200 billion, using derivatives. Moreover, it is not necessary for the central banks to fight the battle themselves. Although central banks' gold sales and gold leasing have certainly contributed to the cause, most of the world's large investment banks have overtraded their capital so flagrantly that if the central banks were to lose the fight on the first front, then their stock would be worthless. Because their fate is intertwined with that of the central banks, investment banks are willing participants in the battle against rising gold, oil, and commodity prices. Central banks, and particularly the U.S. Federal Reserve, are deploying their heavy artillery in the battle against a systematic collapse. This has been their primary concern for at least 7 years. Their immediate objectives are to prevent the private sector bond market from closing its doors to new or refinancing borrowers and to forestall a technical break in the Dow Jones Industrial. Keeping the bond markets open is absolutely vital at a time when corporate profitability is on the ropes. Keeping the equity index on an even keel is essential to protect the wealth of household sectors and to maintain the expectation of future gains. For as long as the objectives can be achieved, the value of the US dollar can also be stabilized in relation to other currencies, despite the extraordinary imbalances in external trade. So, Doctor, I know it was a little bit long-winded, but those 3 paragraphs, when I read them, were extremely prescient, and they still seem prescient today. I want to get your thoughts.
That full late 2019 interview, you will be able to find the link in the show notes below, along with a link to his book. Onwards to today's derivative battle beatdown in both gold and silver markets. It was a rather intense fall in spot prices to finish the week, especially in gold, as we've dipped below the 200-day moving average, which is currently in the low 1800s. The question is gold front-running some sort of deflationary bankruptcy phase building, or was this week's price action another mere paint job of the tape by some of the alleged naked shorts desperate to get out from under their alleged potential losses? It will be important to see how gold trades next week while trillions in stimulus are being created and handed out soon enough. Later in this week's SD Bullion Market Update, we will do a brief look back, an analog example of the last major secular Western-driven gold bullion bull market. We're going to do this to perhaps better garner a sense of the timing of the coming turnaround for gold. Silver spot price also got hammered, as it appears the effort to break the cup and handle formation on the spot price may or may not have been successful. We'll soon find out. The gold-silver ratio hung in tough and closed the week just a touch under 65. A bit of disinformation that spread like wildfire this past Wednesday, which we should squash right now. There was this notion that there has become a massive short position on the Sprott PSLV Physical Silver Fund. That allegation that there's a short squeeze, it was claimed that it had reached 26% of shares outstanding, and people online went into an uproar. Now, when associates of mine and myself, yesterday, we looked under the hood, we found that the short position, while it had increased as of last February 12, 2021 filings, the amount of shorts outstanding only cover a mere 0.7%. Surely PSLV bulls will keep an eye on this moving forward, but at the moment, I'm not sure who in their right mind would want to bet against PSLV. Hello there, this is James Anderson on behalf of SDBullion.com. Before we get rolling in earnest, do me the favor of hitting the like button here so that the AlgoBot knows to serve you our latest video uploads. Also, if you're not a subscriber, do so now and hit the alert bell button as well. This chart illustrates the classic financial market bubble cycle, painted in a red line. It's transposed on the 1970 to early 1980 gold and silver bullion bull market, which merely took 1 decade of time to play out. Now this is the 21st century version, secular gold and silver bull market, which we almost all painfully know had a terrible interim bear market cycle from 2011 through most of the 2010s. Today I crudely transpose the two on top of one another just to get a general sense of how they compare, and you can see that right here. While they are not lined up perfectly in percentage gain terms, this gives us a general idea of things, how they could be setting up for the monetary precious metals to come. This 21st century bullion bull is taking about 2.5 times longer to play out than the last. In every conceivable facet, this current bullion bull market is larger and more wide-scoped than the last Western-driven 1970s bull. Looking back at the late 1978 into early 1979 year for gold price action, we see it took 6 months for gold to finally clear its then nominal price high of $255. Here we have today's gold bullion bull market denominated in fiat Fed notes as well. And we can see we are now 7 months into this current gold price consolidation. In percentage terms, we could fall still further, as last gold bull in the late 1970s, the consolidation fell roughly 20% before the rebound and marching on to its mania phase peaking in early 1980. If we use the 2.5 times longer stretch analog for today's gold bull, we're looking at a new record gold price by later this year. In the last version of the gold bullion bull, gold more than 3 multipled from $255 an ounce to over $800 an ounce. On this very SD Bullion channel, I've laid out multiple times why my belief is gold will more than 3 multiple before this bullion bull peaks out in fiat Federal Reserve note pricing terms. Of course, if high inflation gets running hot enough, all bets to the upside get skewed much higher. I'm merely referring to the fiat M0123 monetary piles already reported in the global financial system. There's no telling how much more is coming ahead. Here we can see the then gold bullion bull of the 1980s versus today's 21st century version. Gold is most often priced and denominated in this fading fiat currency. Thus my thesis remains that the supposed official US gold reserves of just over 8,000 metric tons will have to eventually be worth enough to cover 40% of the M0 and our M1 monetary pile expanding. That also occurred in 1934, and it happened in 1980, by a long shot in 1980. Now, to be fair, this chart looks ridiculous, for it's not in a logarithmic percentage-based format, so we're going to look at it in a logarithmic format, and I'm going to shut my mouth for a minute so you can eye the two different eras. Again, we have no idea how much higher these monetary measures are going to climb through the remainder of this decade, so stay tuned. Closing this week's SD Bullion Market Update, I want to give you out there an update on some of the latest news coming out of the WallStreetSilver subreddit forum. Now with over 35,000 members and growing every week, there is a new GoFundMe campaign that's been launched by the WallStreetSilver members in an effort to raise funds for a Billboard campaign. Only a few days in, they are already halfway to their goal of 15,000 fiat Fed notes raised. Here you can see a few billboards already in place in various parts of the world. I'll leave a link in the show notes if you want to go learn more about the effort to market the silver bullion buying movement to people outside of our current knowing circles and influence. To close this week, this is a screen cap of a Silver Squeeze Star Wars related movie trailer meme I uploaded on my personal YouTube channel. I cannot play it here, unfortunately, because it sets off copyright claims, which is not something I want to happen here on the SD Bullion channel. If you want to see that 140-second action-packed trailer, stay tuned and click through at the end of this update for that. As for the WallStreetSilver visual memes of the week, we have a boatload to run through, which I curated. So please enjoy them, And as always out there, take great care of yourselves and those that you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.